Okay, we are live now.
Welcome, dear viewers, to the fourth talk of our YouTube series being held from 10th to 16th October as part of the World Investor Week. Harmony Talks is bringing this session to you live in collaboration with our partner BSC Investor Protection Fund. The World Investor Week, WIW, an initiative by the International Organization of Securities Commissions, is a global investor awareness campaign that witnesses a host of investor awareness activities. In India, it is conducted under the auspices of the market regulator SEBI. As a part of this, Harmony Talks, in collaboration with BSC Investor Protection Fund, has put together a series of fireside chats with industry leaders, a YouTube talk series, financial literacy sessions, and the like. Today, I'm pleased to introduce to you our speaker for the day, Mr. Chirag Mehta, CIO of Quantum AMC. Chirag has more than 19 years of experience in the financial markets and specializes in the field of alternative investment strategies. He is a qualified chartered alternative investment analyst and has also completed his master's in management studies in finance. He joined the Quantum Group in 2006 after gaining hands-on experience in the physical commodities market during internship and continued association with Kotak and Company Limited, working on projects for the Federation of Indian Commodities Exchanges. Chirag was named among the top 40 fund managers globally under the age of 40 by Citibar UK in 2017. Welcome, Chirag.
Thank you, Eamon. Thank you so much. Glad to be here.
Glad to have you as well, Chirag. As we know, the topic for today being reevaluate your gold investments this festive season. So, Chirag, let's begin with the commodity itself, gold. As an investment, gold has been and will be Indians' favorite destination to park their surplus money in. Although the last 10 years or so have seen some kind of a moderation in demand for gold. Gold prices have been dipping globally in 2022, while in India it has more or less held steady. With interest rates rising and the US Fed looking to continue the rate hikes and the US dollar strengthening, given its relationship with the US dollar, gold, so do all these point towards gold prices dipping in the near future?
Hemant, you were bang on when you said that Indians are kind of natural buyers of gold, and Indian has said or put us in context that they are best fund managers because they are the buyers who take the decision to buy gold. And I think that's paid off very well. So if you look at long-term history of gold, it's beaten inflation and therefore generated real positive returns for all the holders of or investors of gold. So I think it was a wise decision for India because if you look at our currency, it kind of keeps depreciating and therefore it leads to an incremental return over and above what gold generates. So even this year, we have seen that play out very well. If you look at international gold prices are negative, but if you look at Indian gold prices are very much positive, and it has acted as a best diversifier in a market where there is a lot of uncertainty and there is other assets giving negative returns. So if you look at YTD this year, gold is the best performing asset class despite lower returns. It's held on well. Despite the headwinds that we've seen, it's held on well. So overall, I think from the perspective of the backdrop that we are seeing, there are two kind of macroeconomic forces pulling and pushing gold in both directions. At one end, you have central banks who are kind of trying to fight inflation and trying to bring down inflation by increasing interest rates and sucking out liquidity from the markets. At the same time, we have inflation, which is very, very real and much driven by supply side pressures. Which is leading to central banks trying to re-engineer and kill demand and try to soften that inflation burden that's prevailing in the global world today. So overall, there are two kind of pressures: central banks acting, at the same time inflationary pressures, geopolitical worries, all leading to demand for gold increasing. So I think overall, this range-bound movement may continue for some time, given there are two contrasting forces acting simultaneously. But I think as and when we see an impact in terms of growth, uh, faltering, and central banks again taking a U-turn, I think gold should start getting repriced. So overall, there could be similar moment, and we have seen such phases of consolidation, usually great buying entry points for people to buy. So this Diwali, when people are looking to buy, I think it's just not an auspicious purchase. They could kind of increase their allocation to gold this Diwali.
Thank you, Chirag. In fact, you answered part of my next question too, because I was going to ask you about Diwali itself, because Diwali is a very dear festival for all Indians, and we have the gold buying, the auspiciousness associated with gold buying. So,
Mhm.
do you, building upon your previous answer, do you feel that there will be an uptick in gold prices this Diwali? What do you think will be the trajectory of gold prices in the next in the coming years?
Sure. Dhanteras clear remains the biggest gold buying day in India. Everyone either to for an auspicious purchase, or it is kind of their SIP day for buying gold in a way. So if you look at this Diwali, when then each one is questioning themselves, saying that should I just buy for the sake of auspiciousness, or should I try and increase my allocation because gold prices are correcting, consolidating, and giving me a great entry point into so how what the future unfolds is what will determine whether you do a token purchase or you kind of go in and buy some lump sum gold this Diwali. So if you look at the prospects that prevail today, inflation is still very real. What we have seen is central banks trying to fight, and they are fighting until and unless growth is supportive. Once we see recessionary fears coming to the fore because of so much increase in interest rates, and if you see the backdrop that has changed, earlier we had because of pandemic, every central bank cut interest rates. In the developed world, they are close to zero. So it was abundant liquidity, cheap liquidity, or zero cost liquidity prevailing in the global markets. Now we have seen 300% or 3% increase in interest rates in the global world. They are trying to pull out liquidity. So whenever we see the phase where there is cheap money available, a lot of malinvestments takes place. And whenever interest rates kind of move in the other direction, all these go bust, or many of these go bust, because they came into picture because money was available and it was cheap. So everything that had a growth angle to it, money was being thrown towards that. So that could unravel in a very big way. Again, interest rate increases will lower demand, and therefore there could be recessionary kind of fears very much prevailing next 6 months, 1 year down the line. Whenever that happens, we have seen a tendency of central banks to try and support growth and bring back growth. So any time when they look at growth and try to take a U-turn in their policies, which are to today increasing interest rates and pulling out liquidity, to cutting interest rates and pushing in more liquidity, that is when we will see a repricing in gold, which is, I think, maybe 6 months down the line. It could happen in any time. So I think this Diwali gives you a great entry point to increase your gold purchases and not restrict it to a token purchase. You can, if you're under allocated to gold, these are great times to allocate to gold. So if you see the period from 2013 to 2016, we are in a similar kind of period which started in 2021. Wherein gold consolidated, corrected, it made a peak of 34,000, went down to 25,000 in from 13 to 16, and then it started moving up again. So I think we are somewhere similar in terms of trajectory. Gold peaked in 2021, and I think may bottom out somewhere in 23. And I think given the forces that prevail today in terms of central bank being trying to engineer a slow growth, recession fears could come in at any point in time. So while there is still an opportunity and gold prices are lower from its peak, they are still about 10% lower from its peak. So I think it gives you a great entry point from a 2, 3, 5 year time horizon to get in and buy at these levels.
Great insights there, Chirag. Particularly, we have had other talks in this series where there's a consensus from industry leaders that on the equity side, for example, we are probably seeing not a recession, so to speak, because the Indian economy has built in some kind of checks and balances against recessionary shocks, but again, is not totally insulated either. So you could see a mixed bag playing out on the equity markets, and given the relationship gold holds with the equity markets, so we could be spot on in terms of what you're predicting in terms of, if not a bottom, at least a moderation of prices in the near term. And thereafter, it's anybody's guess because there are too many variables at play in terms of how to predict the price of gold, which we probably ought not to be doing. Rather, like you said, I take your point that we need to look at the buying opportunities for gold, increase allocation for gold if you have not already built up enough exposure to gold. So let's move on to the actual the purchasing mechanisms, the formats of gold that we have out there apart from physical gold. We do have the gold ETF, we do have the gold mutual fund, and we also have the sovereign gold bond. Just to start off with, just to familiarize our viewers with what these three are, could you just briefly touch upon these three modes of investment into gold, and then we'll go into a deep dive of each one of them.
Sure, Hemant. If you look at gold ETFs in India came in the year 2007 and globally in 2003. So gold ETFs are, according to me, one of the best financial innovations that we have seen in the global world. Because what gold ETFs does is allows a retail investor buying, say, 0.01 grams of gold at a price where tons and tons of gold get exchanged between, say, a gold producer and a bullion bank. So that is the efficiency that gold ETFs bring from a very wholesale level to a retail level. Because gold ETFs buy gold at international gold prices. There are no premiums making or markups involved that usually are associated with physical gold. So because if you go and buy a physical gold, there will be a huge amount of wholesale markups, retail markups, etc., which makes it really expensive proposition. But gold ETFs kind of cut across these markups and brings that efficiency from the wholesale market level to a retail market level. So a retailer buying a very small denomination is buying at very wholesale prices. And we have seen in the physical market, lower the denomination you go, higher the premium you pay, which is not the case with gold ETFs. So gold ETFs are actually shares which are backed by gold. So they trade like shares on stock exchanges. Each and every unit before it is created is backed by 24 karat physical gold. And therefore it gives ownership to buyers of those units or shares to that proportionate amount of gold that the shares represent. So for example, today, much of the ETF world, gold, each unit is backed represents 0.01 grams of gold. So that is what you can buy when you're buying a gold ETF. It's not just a financial product. It is a financial product or a share or a unit backed by real physical gold. So you don't have to, as an investor, you don't have to worry about purity of the gold, which is usually associated when you buy physical gold, because you hold it up for 10, 15, 20 years. And at the end of the term, if you have if you're selling it, that time when you realize that it's not really the gold that you bought. Maybe you bought 24 karat, it is 22 karat, it is 20 karat, 18 karat. But here you don't have to worry about purity. Plus you don't have to worry about storage. It's stored in professional vaults. It is completely insured, including terrorism insurance. So it is completely safe from that perspective: purity, storage, insurance, and at the same time, it's very, very convenient. You can buy it like a share, own it like a share. It comes in your demat account. So that's gold ETF. If you look at gold funds, gold mutual funds, which is usually called as gold saving funds. These funds are funds that invest in the gold ETFs. They were done for two purposes. One is if you don't have a demat account and still want to buy that efficient gold product, you could buy the gold mutual fund, which will invest in the ETF. So it is a wrapper around the ETF to give that convenience to the investor. So it is like if you don't have a demat account, or if you want to do SIP or accumulate gold for like 5-10 years, You can give a SIP mandate in the gold mutual fund, which is not possible in the ETF. So it allows that convenience to come. At the same time, coming to sovereign gold bonds are gold bonds or bonds backed by gold issued by RBI with a sovereign guarantee. So it does not have any gold backing to it. There is behind the sovereign gold bond, there is no gold that they buy. There is no gold prevailing. It's just a sovereign guarantee that they will make good on the gold prices. That is what you get. Plus, you get an interest and over and above the gold price appreciation. And at the same time, they are tax efficient if you hold it till maturity. But the drawback of that, which gold ETFs and gold funds are very, very liquid, you can buy, redeem at any point in time. Sovereign gold bond lacks liquidity. So if you want to buy, you either buy from a secondary market, which is very, very illiquid, or you wait for a new tranche to come by the government and then you have to buy it. At the same time, when you have to sell, given there is no gold backing to it, they are not fungible for gold. They will usually trade at a discount because a market maker will try to price in the liquidity cost, hedging cost, and therefore they trade at a discount. So if you buy that and if you want to rebalance your portfolio, it becomes very, very cumbersome for you, or it could be disadvantageous because it can incur a loss for you. So from these are the three ways broadly. So if you want a financial product which is backed by physical gold, then you have a clear choice, gold ETFs or gold mutual funds. And if you want a higher return product, because they pay interest, sovereign gold bonds pay interest over and above the gold price, but not backed by gold, very, very illiquid, then you go for sovereign gold bond. So that is how the products lay against each other.
Fantastic information, Chirag, for all our viewers. So just to add on a little bit on the sovereign gold bond, you get a 2.5% interest over and above the prevailing rate of gold. I believe it's the last 3 days of average of the last 3 days of gold prices in the market the day you redeem. And I believe, if I'm not wrong, the purity of gold would be the 99999 purity gold that the SGBA offers. So let's move on to a related question on this. You're mentioning about the gold savings. There is something called a gold savings plan that most mutual funds offer. Could you please explain for the benefit of our viewers, what is the difference? Is it the same as the wrapper that you were talking about, or is this a completely different product?
No, it is the same wrapper that we're talking about. It is a fund that invests in the ETF, and ETF invests in physical gold. That is how it goes. It was mainly done for people because people accumulate gold for, say, marriages within their family, or want to accumulate gold over a long period of time and want to do it automatically by signing a mandate for 5, 10, 15 years time frame. People were used to that habit of accumulating gold in bits and pieces, and that they used to do by buying a small piece of jewelry over a period of time, exchanging it for another piece of jewelry. That is what was the custom that we have seen across India. When people used to buy that jewelry, exchange it for a next piece of jewelry over a period of time, if you do that 3.5 times, you lose your initial investment. That was the case when it came to physical gold. But when it comes to the gold saving plan or a gold mutual fund, what it allows you to accumulate gold over a period of time. And then eventually, if you want for consumption and buy a piece of jewelry that you always wanted, it allows you to do that very, very efficiently. So it plays along the value chain, allowing you to buy gold very, very efficiently, accumulate over a period of time very efficiently, and then convert into the piece of jewelry that you wanted for your daughter's marriage or your whatever purpose you wanted to buy that jewelry set. So when it comes to buying gold, it's high time that people, investors kind of bifurcate whether I want that gold for investment or accumulation, or what I want it for consumption. That is a very necessary distinguishing factor that people have to start doing, because jewelry as a form of investment or accumulation is very, very poor form of doing it, because there are making charges, there are premiums over and above gold prices that you eventually end up paying. And when you sell it back, there is a loss that you incur again. That is why I said whenever you exchange a piece of jewelry for another piece of jewelry and you do it 3.5 times, you lose the initial investment that you have made on buying the first set of jewelry that you did. So it is very, very inefficient, and therefore you need to use the gold saving funds, which allow you to accumulate gold very, very efficiently.
Thank you, Chirag. Now let's get into a little bit of deep dive into each of the products. Now, if you look at the Indian market for gold ETFs, it's about a $1 billion market. Now, if you could talk about the traction, how have Indian investors, gold investors, have received this product, which probably was launched in the early 2000s, right? And what kind of investors are these in terms of demographics? Are these the currently the younger investors, or is it the other end, the HNIs? Who are these people whom you feel are entering into the gold ETF market?
Sure. The gold ETF market has actually grown. It's not become $1 billion market. It's become close to $3 billion market. It's about 20,000 crores worth of gold ETFs that prevail today. And if you look at number of folios or number of investors in the gold ETFs, are itself more than 45 lakh investors. So it's been very well received. If you see the participation, it's across India, given they trade on exchanges like shares, and also the gold mutual fund, given the reach that mutual funds have now in tier 2 cities, B30, T30 cities, there is significant reach. And therefore, that has allowed people, even the hinterlands, to buy gold ETFs from any broking terminal that prevails near their area.
Mhm.
So the reach has been phenomenal, and we have seen participation across India coming through. And if you look at it, it's a very broad mix of retail investors, HNI investors, all going the ETF way. So if you look at sovereign gold bond, there is a limit to which a person can buy a sovereign gold bond, but there is no limit when it comes to gold ETFs or gold mutual funds that you can buy. So overall, we have seen great participation. What is the point that has really appealed to investors is getting access to physical gold while not holding it, because the affiliation to physical gold is so high in India that people choose that preference over the other. And if you look at from a characteristics perspective, gold is no one else's liability, right? Gold is an asset. When you buy a bond, you are actually changing the characteristics from being a asset to someone else's liability, right? Though it is a sovereign liability, but it still becomes or changes form to some extent. And that is why people prefer gold ETFs, gold mutual funds, because of the gold backing that they have. And therefore, they prefer their preference for these products. Only thing is, I think more awareness by such kind of sessions will really help send the right messages across to investors, saying that this is really efficient product. This is really good product backed by physical gold. And at the same time, I pay very, very wholesale prices to buy even at a very small denomination. So I think some more awareness, and I think this form of gold buying will really flourish in India.
Sure, Chirag. So you have hit the nail on the head actually, because that was the express purpose of sessions or talk series like this, to bring out the nitty-gritties, the nuances of these kind of products, which not probably many people understand in its entirety, right? They may know of gold ETF, they may know of the SGB, but what exactly does it entail for them as an investor? Not only today, but maybe 5 years later, what does it mean for them? 10 years later, what does it mean for them? Probably not many investors are aware. So that's what we're trying to bring to them. Now let's move on to the gold mutual funds. If you look at again the traction, for example, and the returns, for example, maybe it was maybe a couple of years back is what I remember, some gold funds returning a 1 year returns of 45 to 65%. Now, while that may sound a little on the heavier side in terms of returns in a year, what is your sense about returns from gold funds in the next year, in the next 3 to 5 years?
So gold ETFs, gold mutual funds will track gold prices, and they will track it very, very efficiently for you. So it's like a replacement to buy gold, basically. Though it is backed by gold, but you change the form from physical to a financial unit or share, which is backed by gold again. So when it comes to returns, I think as we have alluded before, the returns from gold are likely to remain range bound in the near term. But clearly, we may be closer to the bottoming out process very clearly, and it will depend on how the global world pans out from a growth market perspective. There are three scenarios that could pan out. One is what we call as a stagflationary scenario, where the growth kind of falls significantly and inflation kind of still prevails at a higher level. If such kind of scenario happens, that's going to be beneficial for gold, because in such kind of markets, people move out from riskier assets like equities into assets like gold. In the second scenario that we could see, where the growth falters significantly, inflation may come down a bit, but growth falls down so significantly that central banks will take a real U-turn in their policies, which is a very likely scenario as we are heading into. That growth kind of falters much beyond central banks expect, and they in a hurry they can really change stance from where they are. One is they lose credibility. Second is there could be repercussions on dollar could, which is appreciating significantly currently, may start to depreciate because the Fed may be the one who takes the U-turn first, because they have been very, very aggressive in their stance as compared to other central banks. So overall, if there is any U-turn in monetary policy from these central banks, from increasing interest rates towards cutting interest rates, I think that could reprice gold really significantly. A third scenario where gold could suffer is a scenario where there is a soft landing, as they call it. So central banks' policies that they are trying to do or engineer could really work, right? We have not seen that perfection before. So it's unlikely scenario, but if they are able to bring down inflation without much sacrifice on the growth, then gold could suffer. So these three scenarios, two beneficial for gold, one not so beneficial for gold. The second scenario where central banks could take a U-turn because growth suffers looks like a very plausible scenario. So in that event, I think gold should start doing well. So we maybe have to be patient, maybe over next 6 months or so, post which I think markets, as they are forward looking, will start pricing in the scenario where gold could start doing well. So I think this period of consolidation is maybe here to stay in the near term, but again, it should start changing maybe 6 months down the line.
Yeah, and a little bit of a sidebar. I think I remember reading today's paper that our finance minister, she was queried by in terms of the same issue that we are talking about, in terms of inflation versus growth, and one has to take the hit. So there was a categorical statement that, okay, the question was really about the budget. How would that next year, the budget, how would that kind of handle the scenario? And although her official response was that it's too early to comment about the next year's budget, but she did mention that they are going to try and take into account both the factors and
Right.
try to get as minimum a hit as possible on both the fronts. Having said that, if we have talked about ETF and mutual funds, and of course you have given us our viewers the pluses and minuses of both. But if you could just single out one biggest advantage of a ETF over a MF, and one single biggest disadvantage of an ETF vis-a-vis a mutual fund, gold mutual fund.
Yeah, so I think both are very, very similar vehicles. It will give you returns which are very close to each other over a period of time. The only so it's very clear what is your objective. If you want to buy, say, a lump sum quantity, then you could prefer an ETF, because gold mutual fund, it's a separate scheme which invests in the ETF. So there could be double layer of expenses when you want to buy the mutual fund. But if you look at the expense ratio, for example, what we charge in our mutual fund is 6 basis points, 0.06%. So to that extent, it could be different for you. I mean, lesser returns when you put in a mutual fund. So I think if you look at buying just a one-time purchase or something of that sort, then probably ETFs could be a desired form. But if you want to accumulate over a period of time, then I think gold mutual fund is what I will recommend that investors should look at. But otherwise, both are very, very identical vehicles because one is investing in the other to give you that similar price returns of that gold will generate.
Absolutely, Chirag. And I know you talked about earlier in the discussion today. You talked about finding those opportunities to invest in gold. Pushing that logic a little bit further, talk to us about, let's say, an SIP strategy for investing in these gold products.
Yeah, so SIP is a very clear way, and I think Indians understand that really well to accumulate over a period of time, at least when it comes to gold. That is the behavior that we have seen. So we have seen that many will do a monthly SIP and accumulate it over a period of time. Some will do it on auspicious days, that I will buy gold, maybe it's Akshaya Tritiya, it's Dhanteras, or any other auspicious day, they kind of buy. So it's our way of SIP that we have designed over a period of time to buy gold, right? So I think whatever way you prefer, because it averages out your cost each time that you buy gold. So you don't have to get into timing the gold market, whether it's up, down, right price, wrong price. You systematically accumulate gold for whatever reason that you want, be it a portfolio diversification, be it accumulating for managing your family, or for the set that you always wanted to have for yourself. So I think SIP is a great way. It gives you discipline to reach the target that you always wanted and not get into that price calls. Because whenever we have seen that typical behavior, whenever investors want to buy equities, gold, or any other thing, they kind of try and take advice from friends, family, etc. And they get into that call, someone saying it's not the right price, wait, you'll get it cheaper. So SIP does away with all those issues that usually back you off from systematically investing in anything. So I think SIP is a great way. It averages out your cost and you reach your goals that you wanted. So I think gold mutual funds offer that better than anyone else. You can sign a mandate for 5, 10, 15, 20 years, whatever time frame you want, whatever denomination you want. Even you can do a monthly SIP of 500 rupees as well. So that allows you to buy at lower denominations and reach the target that you wanted.
Thank you, Chirag. And I think you right on the dot when you said that Indians know how to save, how to kind of stagger out the investments or savings, and especially women investors, a lot of whom are part of our network community at Harmony Talks. They are very efficient in saving, getting those monthly budgets going, and then I remember one of my relatives, she has been buying one gold coin every month for the last 10 years. And for the simple reason that she wanted her daughter's higher education to be, I mean, that's the way she invested for her daughter's higher education, rather than the traditional route of, going for a mutual fund and then you do a SIP in that. She actually bought one gold coin every month. So that's somewhere talking about how Indian women take it upon themselves to kind of I think the SIP strategy works very well with their investment philosophy, right?
Mhm.
And that's what we have also been seeing. So that's good that you hit it right on the dot there. A little bit about taxation. See, we have the equity funds, the debt instruments. We have the long-term capital gains taxes. There's some exemptions for ELSS kind of products. There's a short-term capital gains taxation. Whereas on the other hand, you have Chapter 6 exemptions or Section 24 kind of exemptions for real estate or property kind of investments.
Mhm.
So where do we see what kind of talk to us about the taxation of the SGB or the other gold products we talked about. And we have touched a little bit upon the liquidity part of it. Could you touch upon the liquidity of the SGB in particular?
Sure. So when it comes to taxation, gold ETFs and gold mutual funds are taxed as debt instruments, which is 20% with indexation. So if a holding is 3 years or more, then it is 20% with indexation. And below that, it's up to your tax bracket. So when it comes to 20% in indexation, people generally don't follow that. They think that it is 20%, but the magic of indexation works really well for you. When it is 20% indexation, if you apply that indexation, we have seen that tax rate falls down to somewhere between 8 to 12%. So it's not very onerous tax, but given the efficiency that you get, given the hassle-free holding of gold that you get, given the safety that you get, I think it's worth uh, that 8 to 12% tax that you end up paying. And even physical gold attracts the same tax when it comes to. So physical gold will have markups, will have premiums. This is without that and at the same tax rate. HGBs, if you hold it till maturity, then there is no tax on it. But if you exit before maturity, you have to pay the similar tax depending on your holding of those bonds. So if it is 3 years and lower, then it as per your tax bracket. And if it is more than 3 years, then it is 20% with indexation. Only if you redeem at maturity, that is when you get, it is tax exempt actually. So if your holding period is very high, then which is a 8-year bond that is issued usually by RBI. So if you hold it for that 8-year period, then you get that tax exemption. But in between, you have to also consider that you may need money somewhere in between, and therefore, you may not really get that tax exemption if you redeem before the maturity. Coming to liquidity, gold ETFs and gold mutual funds are very, very liquid. You can enter or exit at any point in time at close to real gold prices that prevail. SGBs, because they are not fungible for gold, they are not backed by gold, so there is no fungibility like you get in gold ETFs or gold mutual funds. Therefore, they are not very, very liquid. When you try to buy it on the secondary market, you may think that I am buying it at a discount, but if you want to buy a reasonable quantity, I mean slightly more than a few units, then probably you may have to pay equivalent price or a higher price to get those units. And when it comes to selling, given that people may want to sell, and in case of there are no natural buyers, then market makers will step in, and market makers will price in a liquidity cost and a hedging cost. A liquidity cost is somewhere around 7-8%, and hedging cost is around 4-5%. So both combined, it will be at least 11-12% that the HGBs by design could trade at a discount. So you should be, as an investor, understand this trade. And if you're buying SGB and you think there is a chance that you liquidate before maturity, then you should be ready to take some discount, because the design is such, because they are not fungible in nature. So SGB is core in interest and taxation. Gold ETFs, gold funds, I think they rank higher in terms of having a physical gold backing, as well as very, very liquid instruments.
Thanks, Chirag. You talked about the discounting kind of mechanism or a phenomenon that may happen when you try to offload your SGBs in the secondary market. Now, for the benefit of our viewers again, many of whom may not be familiar with how a secondary sale works for an SGB specifically. Bonds in general, we know the mechanism: interest rates rise, bond prices fall. So if you try to offload it in the secondary market, you need to deal with the secondary prices. Do we need to see it in a similar way with SGB, where there are possibilities where if the gold prices fall, the SGB may actually appreciate in value? Does that happen at all, or is it always a discount that we see if we try to offload it in the secondary markets?
No, usually the trend or movement in SGBs will move in line with gold prices. So if gold prices appreciate, SGBs should normally appreciate. And if gold prices depreciate, it should normally depreciate. That is how it will work. It should move tandem with each other. But given the demand supply dynamics are so huge and they are not fungible for gold, someone cannot buy a SGB and convert into physical gold or exit or redeem it at any point in time. They have to wait till that lock-in period is over, and therefore they will price in the very other costs that they may have for keeping that units or SGBs with themselves. So that is typically the hedging cost and the liquidity cost. So they will usually, by structure, if there are many buyers for it, you may be lucky to exit at the right price or at a premium. But in case there are not many buyers, which typically happens when everyone thinks that gold prices have moved up, I should kind of exit out of it. At those points in time, at least they should be trading at a discount. So you should be ready and price that in your holding. Actually,
Okay.
that will be a better alternative.
Okay. So it would be safe to say that for as far as the SGB is concerned, if you're prepared to hold it out till maturity, then go for it. But otherwise, there are some liquidity concerns. There may be some discounting concerns if you try to offload it in the secondary market. So if you're not prepared to hold it out until 8 years, or at least till 5 years when you can prematurely exit, do not go for SGB. Otherwise, you can go for it. Would it be safe to conclude that?
There is one more element to it. Many are allocating gold given it's a great diversifier. Whenever we have seen equity markets fall, gold does well in value. And whenever equity markets rise, gold kind of is subdued. So what happens is you have an allocation to equity, you have an allocation to gold. At some point in time, you have to rebalance those allocations. So today, say you start with 80 equities, 20 gold, for example, and gold prices go up, say from 20% allocation to 25 or 30% allocation, and equities fall, at that point in time, you may want to exit out of your gold holdings to that extent of appreciation and switch it into equities, because that is where you kind of place yourself for the future earnings. And therefore, doing that in an SGB will be cumbersome given the discounts that prevail. So whatever gain you have made, actually you may incur a loss because it is at a discount. So it may not make sense from a portfolio rebalancing perspective. If you're looking at from a portfolio angle as a diversifier portfolio, then I think you have to look at a liquidity of that instrument. Otherwise, you may not be able to do justice to your portfolio asset allocation that you do.
Thank you, Chirag. I'm glad you talked about asset allocation. That brings me to my penultimate or ultimate question. Given that we have discussed the three products that we can talk about in terms of gold investment, what would you suggest? Which kind of investor, which kind of demographic should be investing in gold? Number one, and number two, since you talked about asset allocation, what kind of percentages of your portfolio would you suggest that investors have in the form of gold or gold products?
Sure. So gold helps you do complete two purposes, right? One is it is a great store of value. It will at least give you over a long period of time inflation adjusted returns. So that's a great trade, because we have seen time and again bonds kind of underperform inflation at most points in time, whereas gold has tendency to equate or give better returns than inflation. That's what we have seen. So it's a great store of value. You need to have gold in your portfolio. Second is it's a great diversifier. We have seen time and again, be it a global financial crisis, be it the COVID crisis, when markets fall, gold really appreciates in value. So if you have two engines working in your portfolio, equities and gold, gold is that second engine which will work when your first engine fails. So say a scenario you were accumulating and your goal is kind of, you have to pay for your certain financial goal in year 2008. Equities were down more than 50%, gold was up more than 30%. So gold was that useful asset during that time to help you tide that time when equities were significantly down. You need not have to sell it at a loss. So gold is that second engine of your plane that will help you tide when things go wrong. Coming to the allocation, I think 10 to 15% allocation of your portfolio is what is recommended allocation. And it is not because it's a fancy thing to say. It is because hard numbers back that decision. If you have a pure equity portfolio and if you have a 15% allocation to gold, long periods of time, the returns are nearly the same or slightly better in a 85-15 equity gold allocation portfolio, and your risks are significantly lower. In 2008, when markets fell by about 60%, that portfolio would have fallen by less than 50% or near 50%. So it kind of has protected downsides by an allocation to gold. Also, other risk metrics like shortfall or be it volatility, etc., improves significantly when you have an allocation to gold. So rather than an equity portfolio, equity gold allocation portfolio works really well from a risk perspective while not compromising on the return potential of your portfolio. So a 10 to 15% allocation is an optimal allocation beyond which you start compromising on returns. While you benefit on the risk, but compromising on returns also accelerates from that point. So a 10 to 15% allocation is the most desired allocation that you would have, as suggested by strong research.
Thank you, Chirag. And I like the beautiful way you put it, double engine portfolio. I think that sums it up for most of our viewers in terms of how to look at gold and how to view the investment into gold. Chirag, it's been wonderful talking to you. It's been a pleasure. A lot of comprehensive insights on gold and how to look at gold and the various ways of investing in gold. What are the nitty-gritties, pluses and minuses? So all in all, I think it's been a very good package of information that I think our viewers can take back. I think after the session, they'd be a lot more knowledgeable about investing, a lot more confident in investing in gold than they were before this. So I thank you for that, and it was a pleasure having you here for this talk show.
Yeah, wishing you and your viewers a very good festive season, and I hope they make the right choices when it comes to buying gold. Thank you so much.
Thank you, Chirag, and wish you a happy Diwali in advance. To all our viewers who are watching, thank you for joining us today for this fourth talk in our YouTube series, brought to you by Harmony Talks and BSC Investor Production Fund as part of the World Investor Week. Thank you.